And again, good morning, everyone. Mark Conter here at the Messer Financial Offices. This morning, again, we have the opportunity to have with us Mr. Stephen Perkins, and Stephen is with the Mass Mutual Group here, actually out of the Charlotte area. We've been working with Mass Mutual for a number of years, and we're very fortunate to have one of the ultimate companies available to you as agents in our portfolio. We'll be talking to you later in the presentation about the ability to become contracted with Mass Mutual and have access to the products that they have available on the brokerage side. Stephen is the agency director. I've worked with Stephen and he's done presentations I've been able to attend in the past. Very knowledgeable, number of years in the business. And with that in mind this morning, just the normal housekeeping, you should be muted. We'll ask that if you have questions to go ahead and put them in that question box you'll see on the right-hand corner. We'll address those questions at the end of this actual presentation. And with that in mind, I'm going to turn it over at this time. Stephen, good morning and thank you.
Good morning. Thank you, Mark. This morning, I'm going to talk to you about some LTC funding options that you can use the Mass Mutual Life product portfolio to assist in that process. And during our session today, I'm going to overview, there's two different types of products. I'm going to help you understand kind of where those products fit. I'm going to help position how those funding solutions kind of fit against other products in the industry. And then I'm going to show you some examples of how the actual product strategies can be applied. So that's hopefully what we're going to get accomplished here over probably the next 30 minutes or so. The first thing I want to start off with is this slide where I have what's your number. If you were to go to LTC.gov, which is the has Medicare statistics through the federal government, you'll find out there that approximately 70% of the population is going to use long-term care services, and that 70% are people that reach the age of 65. 70% of the population are going to use long-term care services. I like to position that as an awareness number. So 70% of the population, everybody's aware. I would imagine that most everybody that's on the line today either has a family member or knows somebody that has had to use long-term care services. Well, if you do the math, if 70% use it, it means that 30% do not. What I find is that most people, their perception is that they're part of the 30%. So when they look in the mirror, they don't think that they're part of that 70%. They're aware that it's an issue out there, but they don't think it's going to happen to them. And the reason I talk about this, when you're positioning the product with your clients, whether you're selling a traditional LTC product, which we're not selling today, or not covering today, or you're selling a life long-term care hybrid approach, I think it's important for you to understand kind of where the perception is with your client. And I would argue that a good chunk of the client's perception is that they're part of that 30%. So they're concerned, if I pay the premium into this and I never use it, what am I going to get in return? I personally just recently, over the summer, went through a situation where my father became very ill and then eventually passed away. And he had a traditional LTC product that he purchased back in the early 2000s and has been paying premium on it over the years. Well, due to the way things worked out with him, he didn't use his policy. He had paid an annual premium, and we did reach out to the company and let them know that he had passed away, and we got a return of unearned premium. But that was the only benefit that he actually got out of the policy. So there's a lot of folks that may never get benefit out of their traditional LTC policy. So Mass Mutual has two different hybrid type approach products. Care Choice 1, which is a product where it's a single premium product. We can put take deposits of a minimum of $25,000, and we can take deposits up to what would fund a $720,000 death benefit. But that product, you basically spend down your death benefit, then there's an extended rider that doubles the death benefit as far as the LTC pool. And then in addition to that, this product is participating, so you have paid up additions. And I'll go into the product in detail in an illustration a little later. But really where that product fits, the target market for that product is, it fits in that age 45 to really early 60s. So it'd be your folks that are pre-retirees, that have some assets. I like to call it lazy cash equivalent money. Might be sitting in a CD or money market. And they may also have some cash value life insurance that they feel like that they don't necessarily are not as concerned about the death benefit, but they also have a need for long-term care. You can potentially 1035 exchange into this product. Or it could be a client that has a lot of assets and the client says, you know what, I'm part of that 30%. I don't think I'm going to need it. I have plenty of assets I want to pay. And because when I'll show you a little later that this product actually has a growing cash value and the client will actually make money on their money with this product, it's really almost a financial asset. It works really well for self-insurance people because they can take cash equivalent money, make money on their money, and have leverage for death benefit and long-term care. In some instances, you may have a client that's looking for an alternative to a fixed annuity and or a CD, where they could actually purchase this product and they're going to get a good rate of return, which I'll show you later. And if any of you are working in the business marketplace, it's a great product if you have a business that maybe has a really good year and they'd like to reward their executives. Because it's a single premium, it's a one and done type scenario, and it actually addresses them with death benefit, it addresses them with the long-term care benefit, and they actually have a good growing asset on a deferred basis for the cash growth. So then the second approach that we have is using a legacy whole life product, and it could be any one of the whole life products in our portfolio. We have a 10-pay, a 20-pay, a paid up at 65, legacy 100. We even have a high early cash value product. But we can put the rider on the plan, and it allows you to accelerate the death benefit. Basically, it's kind of like a terminal illness benefit that's driven off of the 2 ADLs or severe cognitive impairment. And it allows you to actually spend the death benefit and the paid up additions with whole life insurance. You have a growing death benefit typically with paid up additions, so you have that additional, and you can accelerate up to 90% of the death benefit. So I'm going to show you there's actually 3 different categories of ages, kind of where it fits. So if you're dealing with younger clients, I know a lot of you deal with older clients in the Medicare market. You may be dealing with the next generation down, the children. Ages 25 to 45, it's a great option, obviously, as they're having family members that are having need for long-term care, to purchase a life policy and then put the rider on it. For the younger people, they may be buying the insurance for risk protection. They may be buying the insurance as an accumulation strategy or retirement supplement strategy, but you could add the waiver or add it on like you would add waiver premium. So it's kind of an add-on, which gives them options in retirement and in the event that they need for long-term care. It works well when you're dealing with business planning and executive bonus scenarios to add that rider, which gives the options. It provides, obviously a lot of flexibility later in life. And we have a concept that maybe at a future date we may do a talk on called Taming a Bear Market, where you're using using the limited payable life product as a market alternative, kind of like a bond alternative that's non-correlated, where you can tap into money when the market is down instead of taking your money when your assets are down. Allow the sequence of returns to bring it back around, and you take the money out of the insurance policy. And then the retirement supplement concept, and I think that maybe a couple years ago there may have been some training on that, and that may also be something that we can address in a future session. So then if we move to the 45 to 64 age segment, middle-aged people, pre-retiree, it works really well, obviously, for LTC planning. It really helps you address that you won't use it, or if you don't use it, you'll lose it, because it allows you to use it one way or the other. It's great, just like in the other age bracket with business succession planning, executive bonus scenarios. It's a really good combo sale to address the term trap. So, we have a lot of people, I call them termites. They want to buy the cheapest life insurance they can. And I always tell people, if you know when you're going to die, you can buy the right kind of insurance. So if you knew you were going to die next year, you could buy an annual renewable term. If you knew you were going to die within the next 10 years, you buy a 10-year term. The big problem with term insurance is, as you need to buy coverage at the end of the term, one, hopefully you're insurable, and two, mortality curve really goes up significantly the older you get. The cost of insurance almost goes vertical, and so as a result, a lot of people get caught in the term trap, and so they need permanent insurance for protection. They also need LTC. You can kind of kill two birds with one stone by selling them a permanent whole life product and adding the rider to it. By using the 10 pay and the 20 pay and also the legacy 65, it allows you to actually have paid up coverage going into retirement, and it's all contractually paid up. So people like that as they're planning for retirement. And of course, it allows you to use it, and I'm going to explain to you, you can actually use the product one of 4 ways. And you actually have the same options on the Care Choice product as well. So then finally, in the 65 to 79 age bracket, so we will do the rider up to age 79. It's a great option for senior age clients that are concerned about LTC planning. It addresses that if you don't use it, you lose it. I'll be careful on how I phrase this, but it's still very legitimate strategy, but it is definitely come into source of funds with the fiduciary rule. But you can use lazy qualified money and or lazy RMDs to fund a life policy with the long-term care. So you can potentially use qualified money. Just know that if you're using that strategy, now that we're in the fiduciary advisory world, there is typically you will need to do a source of funds form with them, some sort of disclosure, and letting them know how you get compensated, just to be in compliance with the new rule. It's a great combo sale to address Social Security and pension income replacement. When people go into retirement, especially couples, and the first one dies, they will definitely have a reduction in their income. They'll lose the lesser of the 2 Social Security benefits. And if they have a pension, if they're fortunate to have a pension, a lot of times it either is reduced or it may even go away if the individual that holds the pension is the first one to die. So having life insurance in retirement is real important to replace that income, but you can also kind of dual purpose it, where it's there for death, it's there for long-term care. There will always be a residual death benefit, so you can potentially address both sides of the equation there. It's also a great combo sale. You may have clients that would like to guarantee that they're going to leave a legacy when they die. A lot of people go into retirement. They may need to spend all their assets. Life insurance is a great way to ensure that there'll be some assets left behind, even if they spend all of their investable assets. And we have a concept that we do called Leave a Legacy with Confidence, and you can add the rider on there so they can also use it for long-term care needs. For the older folks, they like the idea of having, once again, the paid up options. We sell a lot of the Legacy 10. And we also have a program called Single Premium Payment Option, where they can actually write one check, and it's not a MEC. It works in conjunction with a 9-year period certain SPIA. We can illustrate that actually in the ledger, and then they basically write, in reality, 2 checks, one for the first year premium of the life insurance, and then a second check to fund the SPIA, and then it's all handled internally. So I mentioned before that you can actually use the LTC, Mass Mutual Life LTC options one of 4 ways. So you can actually use the benefits, obviously, for death benefit. If they die, it's life insurance. They have a growing LTC pool because of the paid up additions. They have cash that's growing tax deferred. If it's in the Care Choice 1 product, that's normally a modified endowment contract, a MEC, which is treated like an annuity from a tax perspective. So that's tax deferred, but they would have some tax consequence when they take the money out. Not necessarily a bad thing. People buy annuities. So I will argue that if you're looking at not an indexed annuity, but just looking at a fixed income or fixed interest rate annuity, the Care Choice 1 product is very competitive with the internal rates of return with fixed annuities. You also have a pension benefit. So all of the whole life products have the ability that you can turn on a defined benefit with a guaranteed monthly lifetime income that you can never outlive. So literally, this is kind of like the Swiss Army knife of retirement. If they have these programs, it gives them a lot of flexibility depending upon what their specific situation is to be able to use it. So if we move right along as far as how Mass Mutual is really strong against the competition, and both of the products really hold out very well. So Mass Mutual has an increasing death benefit. The universal life options in the industry and all of the other Care Choice 1 type single premium with long-term care rider products in the industry have either a level or decreasing death benefit. Mass Mutual has an increasing LTC pool, and that's growing because of the paid up additions, the dividend. Most competitors have a level pool. They could have an inflation factor in there. And if they have the inflation factor, those are the programs that the death benefit decreases. Mass Mutual has an increasing cash value. Most of the other competitors, either you're stuck, where once you put in the premium, you can't take it out, or in a lot of instances, it's a money back guarantee. And then Mass Mutual has the increasing basically pension benefit with the monthly lifetime income. The guaranteed monthly lifetime income grows every year with the dividends, and the other carriers don't have that even as an option, so there is no pension benefit. So at this point, I'm going to switch gears a second here, and I'm going to go and pull up a sample illustration of the Care Choice 1 first and walk you through that. I had sent over these handouts. You should be able to access them. I'm not exactly sure how you guys deal with that on your end, but maybe Rebecca and Mark can talk to that at the end. But you'll have these handouts that I'm going to walk through with you. So bear with me as I try to get these pulled up on the screen. Okay, so the first one here is the Care Choice 1, and I'm going to keep it the width of the screen just so that you can see the fonts on the screen at a good size. So I'm going to kind of scroll through this. So the first thing I want to show you, this is the single premium whole life. In this example, we're using a 50-year-old male. I'm using a $325,000 death benefit. I'm doing this for illustrative purposes. I will show you the other options on the legacy product with the same $325,000 death benefit. So that's the number I chose. What we find most of the time with this product is people will allocate a certain amount of money that they can deposit into this, and then whatever that creates is the benefit that they generated. But as I said, as in illustrative purposes, in this scenario, I'm just using the 325 just to keep it consistent with the other illustrations. In this instance, we're using it's not a 1035, so this is a MEC as I talked before. The dividend option is paid up additions. That is an option that you could change. So one option you always have with these whole life products is if you wanted to, you could have money paid, the dividends actually paid to you in cash. So that is an option there. We find that most people want the paid up additions because it grows the death benefit and it keeps the cash in the policy growing without having any kind of potential for tax implications. To purchase the $325,000 death benefit, it cost $132,996.50. And then for the rider, which allows the multiplication of the death benefit, so it costs $21,437 for a total of $154,433.50. So this product is bundled. It's not sold where you can just sell the single premium life and not the long-term care. That's a common question that we get. So in this scenario, we're paying $154,433.50. That gets us, as you see down here, a total of $650,000 of LTC pool. And the way this product works is it starts with a guaranteed 48-month benefit. So you take $650, divide it by 48, and it comes up with a $13,541.67 annual premium. Annual premium, monthly benefit for the long-term care. So $13,541.67 monthly benefit. We're starting with a 48-month benefit period, and the long-term care monthly benefit under this program does not increase each year. So on this screen, this will show you how the product works. So you will see over here, the premium is over here, $154,434. Death benefit is the $325. By purchasing the rider, it doubles the death benefit and leverage, which gives you $650. In a claim scenario, you first spend down the guaranteed death benefit. So the first $325,000 of the pool would come out of the death benefit. That's consistent with all the other carriers in this class of product. Then you would accelerate into the long-term care extended pool. And then the big difference with Mass Mutual from the rest of the competition is that we have paid up additions that substantially grow the pool and substantially grow the death benefit and substantially grow the cash value. So if I bring you to this table here, you will see that at age 50, if they became in a need, maybe they get in a car accident, have a stroke, and they become to a point that they need long-term care services, they would have that money immediately. At the end of the first year, the cash surrender value in this scenario is $136,709. Over time, it grows. I will show you later, but in year 4, they're making money on their money based on the current assumptions. Mass Mutual is currently crediting 6.7% dividend, which is the industry high of all the carriers. We're at a 43-year low. So I got to believe interest rates will turn and we'll go back up and dividends will follow. So hopefully we'll do better in the future. But based on our current assumptions in year 4, you're making money on your money. If Mass Mutual never paid an excess dividend, which has never happened in the history of the company that dates back to 1860, but if that was the case, you'll see here on this chart that we have that If you look under the policy surrender value here, we're at 207,882, so the 154,434 by age 68 has grown to 207,882, and by the time we reach age 85, it would be 270,322, all on guarantees. The death benefit would always stay the same. The long-term care pool would stay the same under the guarantees. When we add in the dividend, the 6.7% dividend, you will see that the LTC pool grows over time to over $1 million by the time you get to age 85. You will see that the monthly benefit period grows because the paid up addition pool continues to grow and the monthly benefit stays level. So by the time we get out to age 85, we can draw up to 77 months of benefit, assuming we took the full $13,542. This is a reimbursement policy, not an indemnity policy. So they would have to have expenses each month of $13,542. If they did that for 77 months, they would have used the LTC pool. You'll see that based on current assumptions, by the time they get to age 85, they've basically quadrupled their money, their original deposit. And you'll see that the death benefit by the time they reach age 85 has grown to $740,013. If you look at a typical claim scenario, it's typically going to last 4 years or less. The average claim duration for a male is less than 3 years. The average for a female is a little less than 4 years. But assuming you had a 4-year claim, you would have spent $650,000 in this assumption that you had expenses of $13,542 for the full period. Well, you would have spent the $325 of the guaranteed death benefit, and then you would have spent all of the long-term care extended benefit. But if you subtract the $325 from the $740, you would be left with $315,000 of a residual death benefit that would be paid out. So from an actual claim scenario, if long-term care came into play, even if you use the long-term care, you're going to have a significant death benefit that you'll pass on to the next generation. If you look at peer competitors in this product class, they're typically, if you had a claim, their residual death benefit is $10,000 to $25,000, and that's it. So it's more of a final expense type of thing. As I come down here, showing you the internal rate of return, so you'll see by year 4, you're at 9 basis points that you've made. By year 10, year over year since inception, you're actually, in this scenario, outperforming 10-year treasuries. And by the time you get out to year 20, you're in the mid 3s, 3.65%. That's a really good cash equivalent internal rate of return. And as the dividends adjust and go up, these internal rates of return will go up. You also get a really good internal rate of return on death benefit. And if you go out to life expectancy, and we'll just say our life expectancy is around 85. For that person that was going to self-insure anyway, they would have had to have made 4.45 after tax year over year since the inception. The money you're typically going to take to put into this is going to be safe money, cash equivalent type money, and that's a really good would be a really good rate of return to push on to the next generation. And then as I come down here, I'll show you that let's say your client gets out to age 70 and they decide that, hey, you know what I really need is additional income because my spouse died and I lost the lesser of the 2 Social Security benefits. At age 70, based on the current assumption dividend, they could pull $1,465 of pension benefit a month and never outlive that. And in addition, this column here, where this $10,718 is, they would get a one-time refund of unearned long-term care extended rider premium, which is $10,718, and then they could start drawing the money. So it gives them a lot of flexibility from that perspective. So with that said, I'm going to close this one out, and we're going to move on to the 10 pay. So the last product I showed you, the Care Choice 1, the long-term care rider is really buying in essence, a long-term care policy that kicks in at the end of the 2 years, and it's priced based on morbidity pricing. The rider that's on the 10 pay, and I'm going to show you an example with a Legacy 100, is basically giving you the right to get your death benefit quicker. You're not getting any money in addition to the death benefit, so you can accelerate 90% of the death benefit, and plus the paid up additions. And this product requires that there's a minimum of $25,000 residual death benefit. Typically, you're going to need to be looking in the 98 to 108,000 range of face amount to be able to add this rider on the product. So we couldn't do a small face amount and add the rider. It has to be up in that range. The minimum monthly benefit on this product is $3,000 a month with a 2-year benefit period. So we do the math to back into that. So with that said, if you look here, age 50, 325, you'll see that the annual premium, this is a 10 pay for the life insurance, is $15,895.75. To add the rider is $570.41. Because we're accelerating 90% of the death benefit, you'll see the pool, the monthly benefit pool is $292,500. Residual death benefit of $32,500, which gives you a monthly benefit of $6,093.75. The way I designed this one was a 4-year benefit period. We included an increase option that doubles the monthly benefit by age 85. So it's like an inflation protection that you would buy on a traditional LTC. And we included the paid up additions in the pool. We have a lot of flexibility on how we can design this, but that's where we can work with you and Mark to come up with the best options. We also have a single premium payment option using that 9-year period certain SPIA that we talked about. Ironically enough, we were dealing with a premium in the $154,000 range on the Care Choice. It's about the same on using the single premium payment option by the time you fund the SPIA and the 1st-year premium. But I just wanted to show that to you. The underlying product is a normal whole life product, so you'll see that we're making good internal rates of return. By the time you're 25 years in, you're over 4% internal rate of return on cash. So the cash internal rate of return is better in this product than it is in the Care Choice. You'll see that the death benefit internal rate of return is a little better too. And then you'll see the pension benefits in this chart here. If we go to look at the long-term care benefits, how they're growing in this chart, you'll see that in the first column, the monthly benefit increases each year. If you look at the guaranteed values, if MassMutual never paid a dividend, you'll see that the monthly benefit would decrease because we're opening up the faucet as to what you can take out of the death benefit pool, and it's not getting filled back in with paid up additions and the guaranteed values. If you look at the non-guaranteed values and the power of the dividend, you'll see how that pool grows, and you'll see also that the monthly benefit period grows because of the dividend over time. When we illustrate this for you, there's a great summary page in here that shows you what would happen in a claim, and we can dial this into a year, but we typically will default to an 85 age. So in this scenario, your client would have paid in $16,466 a year for 10 years, a total of $164,662 guaranteed. The death benefit by age 85 would grow to $735,467, and the monthly benefit would have doubled over time to 12,188. They would have been eligible at 12,188 a month of expenses for 59 months. They would receive 726,269, and assuming they died immediately following, the residual death benefit would be 135,148. So as you can see, this really shows how there's a lot of significant value. So on 164,662, your basically client is going to get $850,000 in tax-free leverage, which is phenomenal. In light of time, because I want to keep us as close to half an hour, and then I'll answer some questions. I'm going to close that out, and I'm going to move to the Legacy 100. And let me pull that up on the screen. And let's see here. I'm going to take you, just go ahead and take you to that same screen of the claim value. So in this scenario, so keep in mind, we're paying premiums up to age 100. In this scenario, we're just showing the same claim value. The monthly benefit's the same, initial death benefit's the same. Obviously, since we're paying longer, the premium is less on an annual basis, but actually you can see the cost over time is a lot more. It's 303 versus 164,000. So it's 8,188. You'll see the death benefit grows to 751,347. You'll see that the pool's a little less. We get 61 months. I'm sorry, must be a little more. Payable for 61 months, we get 746,870, and a residual death benefit of 191,353. So you can see that even with a Legacy 100, you're getting, in this instance, over $900,000 of leverage, but the leverage is not quite as good because we're paying for a longer period of time. So 303,658 is what we have in, and we're getting basically 3 times leverage between the long-term care and death benefit. So just to wrap up on that, we talked about the different funding solutions and where they fit and kind of how to position them. We've kind of talked about how they're applied. At this point, Mark, why don't we open it up if there are any questions that I can answer that you have on your screen.
Yeah, that'll be great. We'll go over there in just a moment, Stephen. A couple of things. Number one, could you give us a little info on contracting?
Yes. So first of all, in order to sell this product, you do have to hold a long-term care license, and if there's suitability requirements for the state where you are located, you'll need to also have completed that. Our preference is for you to be contracted first on this, so that we know that you're suitable, and secondly, in our processing, if things go a lot quicker if we already have producer codes set up for you when the app is submitted here. So historically, we've taken a different approach with contracting with Mass, but we are now going to allow folks to go ahead and pre-appoint so that they're all ready to go, and we can make sure that everybody is set up properly and have all their proper certifications and licenses prior to us quoting the cases and submitting applications.
Yes, thank you, Stephen. And of course, to all of you on this webinar, you're the privileged few right now. You've heard this right from the horse's mouth. We've never had the opportunity to have you license or contract with the company until you had a piece of business. But again, as Stephen is emphasizing, we want to have that already started. Make sure all your ducks in a row before you go ahead. Also, again, completely make sure that you are long-term care licensed in your state. Let's go over it, as you mentioned. Usually at the end of these, Stephen, I do a recap, but okay, of the information that we have here and all the notes I took is going to take us well beyond our time. So again, ladies and gentlemen, fortunately, this has been recorded. You will be able to access the Messer website to the Learning Center. Rebecca will get this posted no later than, basically, let's just say a week from today, because I'm sure with all the information, again, that Stephen shared, I couldn't even take notes as fast as I needed to because the benefits are so rich in everything that you saw. So this might be one of those that you need to go back to a couple of times. Also, the information that was provided in the illustration format, you can see on the right-hand side of the screen. Each one of those has been downloaded onto the Adobe format. You can go ahead and left-click on those if you're at your computer. You'll be able to save it, drop it into your MassMutual long-term care file, and you'll have these to review as you need to. The other thing is, if you're not on your computer today, if you're listening to us through some other sources, of course, you can contact us here at the producer support line, which is extension 813, and we'll make sure that these can be made available to you. We can, of course, email them to you in that format. So as far as the questions, let's get over to that screen now, and they are limited, and I'm sure it's a lot of it has to do with the nature of the information. So if you've never sold long-term care before and you're not licensed to sell it, this was certainly an overwhelming session of great information. If you are appointed and you've done it or you've tried to get your feet wet in it, I'm still going to say it was an overwhelming source of information for you. So the one question that we do have up, Stephen, is are these funds available to a family member, or do they need to be paid directly in the long-term care to a facility?
So that's a good question. So it is a reimbursement contract, and so the family members can access it. Now, in a claim scenario, that's kind of there's about 3 layers to answer this question. First layer is if your family member is insured and is in a skilled facility, I'm sure that arrangements can be made that the payments could go direct. On the other side of that, it is designed as a reimbursement where you can submit expenses and get reimbursed. It is going to be for qualified expenses, no different than a normal traditional LTC. So you would have to, if you had home health care, you'd have to have certified aides and certified services. Typically, that's done through one of the agencies. So on the long-term care benefit per se, that's how that works. But one of the advantages of these products is you also have cash value. So you can use the cash value for whatever you want to use it for. So I've done cases where we have an uninsured spouse, and we'll put one of these on the insurable spouse with the idea that, hey, if the insurable spouse needs it, we can spend the death benefit. But if the uninsurable spouse needs some help, we could actually pull the money out and just use the cash value to help with expenses. So you can even use the cash value during the elimination period to help cover expenses, where you just pull money out of the paid up additions bucket to take surrenders out to pay the expenses until the elimination period kicks in, which is 90 days.
Thank you very much, Stephen. And ladies and gentlemen, again, I think some of you on the program today, I recognize some of you I've helped with illustrations in the past. I know that you're quite aware that anytime you come to me looking for the benefits of a whole life policy, I have continued to pound the benefits that are available to you by using MassMutual. Again, Stephen hit on it very strongly today. Stephen, could you go ahead one more time and repeat what the current dividend is and how that looks in respect to your competition?
So MassMutual has been the industry leader for a number of years, and our dividend rate today is 6.7%, and we are significantly at least 50 basis points higher than all of our competitors. To put things in perspective, Northwestern Mutual is at 5%. New York Life is at 6%. Guardian is about 6%. MetLife is now at 4.5%. Of course, they're out of the business now. So in other peer companies, none of our peer companies are any higher than about 6%. The secret sauce for MassMutual is a mutual company, so we do everything for the benefit of the policyholders. MassMutual is managed very well, and in addition to just having the insurance company, MassMutual owns Oppenheimer Mutual Funds, which also owns Barings, and also has a pretty significant retirement services company, a trust company, and a very large broker-dealer network, which is at this point top 5 independent broker-dealer firms in the country. All of the revenue that comes off of that, all of the profit that comes off of that, ultimately comes back to the policyholder and policyholder value, either through part of the dividend and or putting additional money away for the capital surplus for a rainy day. So that's really the MassMutual story. Very well managed company, and that's why we've had such a great track record.
Again, thank you, Stephen. And also for your information, ladies and gentlemen, if you need another little crutch when you're in the selling mode and presenting those benefits, there is a wonderful tool that shows the dividends as they have appeared with the company for the past 10, 20, and I think they even go back further than 20 years, don't they, Stephen?
Depending on which piece you have, we have one that goes back, I think, 100 years. So yeah. We have all kinds of materials, and if you find that you need additional information, let Mark know. He can reach out to us, and we're happy to support.
They really are, ladies and gentlemen. I mean, again, Stephen's with us today, and he is the agency brokerage director. I think you would, need to understand the significance of that, because many times when we do have a carrier represent themselves, you're not going to have the top dog in the organization at your access to teach you what's going on. And that's what you've been provided with today. And again, thank you very much, Stephen. He's got a great assistant, Joe Miller, right here in town. Joe will help you design illustrations as well as you're calling us for that assistance. So you do have a network out there to fall back on. And again, you've got experts here that can help you deal with and understand how these benefits can work with the different clientele that you're going to find yourself facing. I think the most important thing to recognize, again, too, ladies and gentlemen, is our industry currently right now is in the throes of change, and I highly recognize these changes as being greatly beneficial. The fact that carriers offer with their term life products living benefits, something that was unheard of years ago, that can take you into another realm of business opportunity. The fact, though, that you've got products here on the whole life chassis again that are going to allow you and your clients to use the hybrid format, and that's the hot button, that's the term out there right now, to again, as Steve emphasized, get you away from the thought of long-term care that I spend money on, that expires at some period of time because I outlive it and I never see the benefits that I've paid for. The hybrid long-term care is a hot button. It's out there. The public is aware of it. They're not really understanding it, but they know it's there. So you've probably got the greatest opportunity that you could ever have in our industry to bring out these products to the clients you're going to work with as you look for those life insurance clients that now, instead of just saying, well, I'm going to add a disability rider to this because that's going to be great for you in case, God forbid, something is happening, you're going to go the full extent. You're going to take them out 20, 30, 40 years down the road with a thought and a protection that they've never seen before. So again, I can only tell you how wonderful this is to have available, and we need to get on the wagon. We need to start making these available. You're about to go into your market season. You're about to meet with clients 65 plus, and it's time for you to go in there and dig and find out what opportunities you may have as soon as you close it out, so you can go back and present this type of information. Stephen, again, I just want to say thank you again, because you really have gone one step beyond what we've had in the past. And again, ladies and gentlemen, you're offered this opportunity for the first time to go ahead and apply on the contracting tools of Messer to get that Mass Mutual contract in order. But again, remember, you've got to have that long-term care license. So don't come running to us wanting an appointment without that long-term care. Get that done and get yourself prepared for certification that you may need to do to maintain that license in the future. Stephen, anything else you might want to add at this point?
No, I think that's it. That's all I've got.
All right, ladies and gentlemen, thank you very much again. We look forward to you joining us again next Wednesday, same time, same station. If perhaps you haven't already become aware, our expo is following up right behind this. We'll be in business for the 11th and 12th of September at that center here in Concord. And then we will skip the 13th as far as a webinar training. So again, thank you all for joining us. And again, thank you very much, Stephen, for the information that you presented to our agents today.
Thank you.
And ladies and gentlemen, we'll leave the screen up a few moments just in case you need to and haven't downloaded those Adobe files. So we'll give you a couple of minutes here because we're a little bit early. And after that, then call in if you haven't got to them by then. Again, thank you, everyone. Okay, I hope by now everyone's had an opportunity to download those. We'll go ahead and close off our screens. Again, if you don't have it available, please go ahead and give us a call, and we'll be sure to be able to email you these files. Thank you very much.